The following presentation is brought to you as a courtesy from Forex Academy. This is part of our service Advanced Technical Analysis course. If you find it interesting and wish to be updated on new releases, please subscribe to our YouTube channel or join our community at forex.academy and receive all our services for free. Your like is also highly appreciated. Enjoy.
Hello everybody and welcome to another installment of the live Advanced Technical Analysis course. Today's webinar is webinar number 8 out of a total of 12, and it will encompass the second of a total of 3 workshops that we will go through during this course. So today is the practical workshop number 2. Forex Academy is an online provider of educational facilities to traders of financial markets and cryptocurrencies. All of the content that you will view in the Advanced Technical Analysis course is educational material with the purpose of introducing you to various tools, techniques, and methodologies that fall under the subject known as technical analysis. In time, your ability to understand and apply these tools and techniques has the potential to contribute towards an improvement of your ability to both analyze and trade instruments in the financial marketplace. Before we continue, please just bear with me. I need to go through a few pieces of housekeeping issues. Feel free to ask any questions throughout the webinar. You can locate your chat box on the right-hand side of the screen. I will obviously be able to view any questions that are asked during the webinar. This is a live webinar. It is being recorded and will be placed in your members area once the webinar has concluded. We will be hosting an extended Q&A session at the end of this live webinar, as always, so that will give you an additional opportunity to ask more questions. The course overview follows the same process each week, whereby we cover some educational material over 3 webinars, Monday through to Wednesday, and that is then followed by a technical workshop, which recaps on some of the topics that have been discussed and reviewed over the previous 3 webinars, but applies a more practical application and in some cases a real-time application to applying these tools and techniques so that you get a much more hands-on introduction to how one can use these approaches. The same will apply for next week. We will also conclude the Advanced Technical Analysis course with an end-of-course workshop, which will then also just look to incorporate all of the material or the bulk of the material that we have covered over the course of the Technical Analysis course, and principally illustrate how you can then take all of this information and all of these tools and techniques to develop a disciplined approach to markets. In today's webinar, we will follow sort of a logical process of illustrating how one can incorporate technical analysis into a solid trading plan, the challenge in terms of trying to achieve the ability to develop robust skills that are necessary to read market conditions. We'll have a lot of discussions over the course of the webinar with some final considerations at the end of today's subject matter. Okay, so considering various tools and techniques in terms of incorporating technical analysis into a solid trading plan, let's also just recap some of the topics that we've covered thus far this week. We initially looked at price patterns and we highlighted the fact that identifying price patterns allows one to capitalize on these opportunities once they have been identified. So we will consider the process of identifying price patterns today and also look at how one can capitalize on these patterns. The concepts of when to trade, at what level to trade, and how to consider taking that trade is very important. We need to look at fine-tuning this challenge so that it can improve our ability to trade the markets. We'll look at some concepts in the second half of today's webinar, whereby we'll incorporate things like trend definition, momentum studies, slopes of moving averages, to show you how we can fine-tune the challenge of when to trade, at what level to trade, and how to develop that trading strategy. The trend is always extremely important. Never ever forget the importance of the trend. You're looking to trade the direction of the trend. Therefore, it is absolutely essential for you as an analyst, first and foremost, prior to your trading decision, to always be on top of the trend. We'll also look at considerations, as I've just mentioned a few minutes ago, around momentum and moving averages. We will then end the webinar in terms of showing you how you can put all of this information together to develop a strategy and ultimately lead to more effective trading. Finally, risk management is always important. Some traders will say it's the most important element when it comes to trading. I must be honest with you, I would wholeheartedly agree with that point. One reason why your risk management is important is because it will determine whether you survive over the medium to long term. It's just one thing and one aspect of trading to identify the correct direction. Remember though that you can still make a loss even if you determine the direction of the market correctly. A very profitable position can very quickly turn into a losing position. These are all the realities of trading. So risk management is absolutely essential. And in all of the various topics that we look at over the course of these 12 webinars, we will always bring in to the discussion the relative importance of risk management. Okay, so in terms of our first practical application to the markets, we will take a look at price pattern considerations, and we will show you how this can be applied in a more practical sense. Now, a few things to take on board before we look at an actual chart is that reversal patterns take time to develop. The reason for that is because they reflect a changing view in the market. In other words, they reflect a change in market sentiment. Therefore, you should give these patterns the time they deserve. Allow these patterns to evolve, also principally because they are a warning sign. We have no guarantee that if, for example, you were looking at a head and shoulders reversal or a double bottom, whether these patterns will ultimately develop into that potential head and shoulders or the potential double bottom. So wait for these patterns to evolve and give them the time that they deserve. Very important that you never preempt a pattern. Further reinforcing the point that I've just made in terms of the fact that we have no guarantee that the pattern we suspect might be developing ultimately turns out to be that pattern. Preempting a pattern is risky trading. If you do decide to preempt a pattern and you take a trading decision on the basis of a double bottom in anticipation of that pattern being confirmed, be aware of the risks of your decision so that you are not surprised by any adverse outcome. Patterns are beneficial because they provide you with clues relating to trend. Is the trend continuing, or is there a reversal threat? If we consider reversal patterns, you may recall from our discussions earlier this week that the one thing that we try and achieve from the use of technical analysis is to gain an insight into the underlying strength or weakness with respect to a trend. By being able to observe the early stages of a potential reversal pattern, you are in turn then developing the early stages of some inherent weakness that exists in that trend, i.e. it's leading to a reversal, and that then highlights a potential shift in the market sentiment. So with patterns, we are always able to assess whether the trend will likely continue, if we are dealing with continuation patterns, or whether there is a reversal threat. Forward thinking is absolutely essential, and we'll look at one or two illustrations over the course of today's applications in terms of applying this idea. You're observing outcomes, and by being able to identify and observe those outcomes, you are prepared for any eventuality. Okay, so let's move on to our first practical application. And what we have in front of us is a chart that highlights a potential price development. We need to ask ourselves a few questions. Firstly, what is the trend? Now, before we continue to complete this particular slide, what I'm just going to do is I'm going to call up a chart to focus on the exact same price action that we've just looked at in the slide in front of you. So, as an analyst, you will recall that we need to determine, first and foremost, the direction in the market. Why this is important is because it will determine what type of trading opportunity we will be looking for. It will also allow us to identify whether there are any threats to the underlying trend that has dominated. So in front of you, you have a certain amount of price information. If we consider the price information from the left-hand corner of the chart down here to where prices travel to, it is very clear that the trend that we've been dealing with is an uptrend. In other words, the market is bullish. We've made a very important initial observation. Why that initial observation is important is because we need to start our trade logic from a bullish perspective. In other words, will we be looking for buying opportunities in this market? More importantly, we need to look at more recent activity because this is where we're currently trading, and we need to identify whether at this level or anywhere close to this level there exists firstly a buying opportunity, or whether we can highlight any potential concerns around the underlying direction of the trend which has been up thus far. Remember that the definition of a trend, this is something that you should never ignore, is defined by a sequence of higher highs and higher lows. That is very evident on this chart in front of you. If we just follow the support levels, you'll recall that we identified the fact that an uptrend is defined through its support levels, whereas a downtrend is defined through its resistance levels. Looking at the most recent price action, we can see that price has found resistance at this level over here. Try and label that with an R, perhaps 1. Price action pulls back, finds support once again at this particular level. That's perfectly normal. In an uptrend, we do have corrections because an uptrend is made of sequences of highs and lows. You can see clearly corrections during this phase, corrections during that phase, and once again during this pullback over here. So corrections are a perfectly healthy outcome for a trend. Price action then finds enough support to start pushing prices higher. We've noticed more recently, remember we're trading at this particular level, the price action hasn't really been able to do what it's done in the past. In other words, on the recovery of the corrective low, generate a new trend high, and for at least a period of time, follow through on that break to new highs. If we just extend this line across, we can see that the market has once again found resistance at the same level it found at R1. This forces us to ask certain questions. First of all, why is price action unable to continue in an upward direction, having recovered off this particular low over here? And does that raise any concerns around further prospects for gains in price action? So what we've actually identified is we've identified a potential change in the way price action is behaving. And you recall from one of the points that was stressed a number of times this week, if you observe price action closely and you notice a change in the way price action is currently behaving relative to the way in which it's behaving up to that point, then that is an early indication of a potential threat to the existing trend, i.e. an early indication that market sentiment could indeed be changing. One aspect that we discussed around this concept was through the use of price patterns. Price patterns give us a clear indication that the behavioral element of price has indeed changed. Now, if we understand price action, we can then pay close attention to the fact that we've been able to identify two resistance levels, or to use another term, two tops in this trend. If we go back to our theoretical observation of price patterns, one element that we covered was a pattern known as a double top. And you'll recall that a double top was an important reversal pattern. So we've made two observations in the discussion that we've just had. Firstly, that the trend is up. However, we've become a little concerned about the market's ability to push higher because the market has stalled twice at roughly the same level. Are we then dealing with a potential double top? This is the observation that you make when you're looking for price patterns. It puts you on alert from a trading perspective. You may say to yourself, let's say you're in a very fortunate position where you've been long from the low of this chart. As price action has moved higher, you've followed and been able to identify the support levels around your trend identification, and you've raised the stop loss accordingly. Your stop loss might be sitting here at the moment. You may say to yourself, the existence of this double top reversal leads me to believe that I need to focus my attention on this point, which, as you will recall, something that we'll identify very shortly again, is known as the midpoint. Therefore, I will raise my stop loss to above, or rather below, this particular support level. So from a pattern perspective, what we are dealing with now in this particular market is a potential bearish threat in the form of a double top pattern. If we go back to the chart, we can then ask ourselves, what observation have we made? As we've just discussed, resistance has capped recent recovery. Can I label this activity through the discussion that we've just had? Yes, we can. It is a double top. What does this mean? It is a reversal threat, as simple as that. So this is you can follow this process, if you like, in terms of a checklist of factors. Ask yourself the trend. What observations can I make from price action? If there is any activity that you've been able to identify, can I label the activity? If I can, what is it? If I'm able to label it, what does this mean? And that can then set yourself up, or it allows you to set yourself up for some strategies that you can consider going forward by understanding what threat a double top reversal brings to the equation. Therefore, you are forward thinking as well at the same time. So let's go back to this chart and just recap in terms of what we've been able to identify in price action. Firstly, we've clearly been able to identify two important tops in price action. As we've just stressed, this is a double top threat to the uptrend. The next thing that we need to do is to identify our midpoint. So if we go back to the chart, you'll recall that the midpoint is the lowest point between the two peaks in the pattern. Therefore, that becomes a very important support level. And what I'll do now is I will draw my horizontal line to reflect that midpoint. That was the reason too that we placed our stop loss below this level, assuming that we were in a fortunate position of having been long from the lows of the price action that we have in front of us. The midpoint is important because what the midpoint will tell you is that if it is indeed broken, then yes, we have a confirmed double top, the trend has reversed, and market sentiment is now bearish. One point that we have stressed over the course of the various webinars thus far is that you shouldn't just focus your attention on applying one tool and be comfortable that you have enough information in front of you. We need to bring into the equation certain other trend analytical tools to give us perhaps validating information in terms of what we are considering around the double top, or perhaps it might even contradict it. One thing that you can consider as a first step is to use a trend line. Remember, what is required from a trend line is simply to identify the starting point. So for illustrative purposes, we'll just pick the lowest point in the chart, and we need to connect it to a certain other low. You can clearly see that what we have here looks like a relatively healthy uptrend, or rather trend line, as a reflection of the uptrend. Very important that we have starting point, second point to create the line. We've extended it forward. We've seen that on this particular occasion where the market pulled back, the trend line provided enough support to maintain the uptrend, and price action has ultimately moved higher. So we can come to the conclusion that this is an acceptable trend line to use. If we had many more points going forward, then it would further increase the validity and the relevance of this trend line. What is interesting from the observation of the trend line, because we're most interested in current price action, and we notice that price action has been falling most recently, is that the area around the trend line corresponds quite closely to the price level around the midpoint. Therefore, if we do see a double top confirmation, that will also then confirm a break of the trend line. And trend line analysis essentially tells you that your trend line should be regarded as a good representation of the trend. If price action is holding above the trend line, the trend is up. If it breaks below it and starts trading in a consistent manner below the trend line, then the break of the trend line is an indication that the trend has reversed, implying market sentiment has changed. In this instance, if we have both a double top reversal or double top confirmation together with a trend line break, then we have two factors that are suggesting a reversal in trend, and certainly two is better than one. Your goal is to try and get as many technical readings that point in the same direction, because that ultimately then reinforces not just the view that you're taking on board, but as a trader, it'll reinforce your underlying conviction in taking on board that information and executing a trade on the back of it. So we've brought in a trend line to give us some additional information relating to the trend. If we go back to our chart, we ask ourselves whether we can make any additional observations, perhaps a trend line. We've identified a trend line, and you can see in the chart how the trend line coincides in terms of price levels close to the midpoint of the double top. Therefore, we have enough information now where we can start to consider planning our trade. Now, you can attack this in a number of ways, and we'll go back to the chart and look at a couple of options. Remember, the market is made up of many opinions, and many different opinions, more importantly. We need those differing opinions to make a market. Just because we've been focusing our attention on a potential double top threat and highlighted a trendline support, and the focus has been on if we confirm the double top, we'll also confirm a break of the trend line, therefore the trend will have reversed. There's a big if around all of these. In other words, we need to see all of these confirmations occur. If, however, your decision is to maintain a bullish stance, then you're also making a strong decision to continue to trade in the direction of the trend until the trend gives you enough evidence that that trend has indeed reversed. So your first consideration could be, I still believe that the trend is up. I will continue to buy this pullback ahead of both the trend line and the midpoint. I know where my risk parameter is. Very important that you're able to establish a risk parameter. It will be the low or the midpoint of the double top. And if it breaks below there, then I will accept a loss on this position because the market will have indeed reversed. At this stage, it's important to evaluate that we haven't confirmed the double top and we haven't confirmed the trend line support. So you may still come to the conclusion at this point in time that this market is still a better buy than it is a better sell. However, your forward-thinking process in terms of analyzing the market correctly has placed you in a position where you understand what the existing threats are to your underlying view. In other words, you have a very good understanding of the market conditions that are present in this particular instrument at the moment. And that is a very strong position to be in. Let's take a look at what happens next. Okay, this is the subsequent price action from around this area over here, which we were looking at earlier. And you can see this is a daily chart, over the last few weeks, price action continued to sell off. We had initially a trend line break at this point, and then at this stage, about 2 or 3 days later, we broke the midpoint of the pattern. Therefore, if your view was to buy the current pullback, you would have been aware, and rightfully so, to place your stop loss below the midpoint because long positions were no longer a viable option once the midpoint was broken. We can clearly see in this instance that having broken the midpoint, the market has continued to trade in a downward direction. So clearly, your early observation of a potential threat to that trend would have not created an element of surprise for you had the market continued to move lower. You would have been prepared for that eventuality. Very important that you're able to establish and read markets in exactly the way in which I have illustrated thus far.